Hello and welcome to the How to Trade Like a Pro podcast. I'm Wieland Arlt, and in this episode I welcome Alex Spiroglou, and he is the inventor of the MACD-V indicator oscillator, and what this is about, this is what we will discuss in this podcast. Before we start, please take a closer look to the risk disclaimer in the show notes, and now let's go. I'm here together with Alex Spiroglou. With Alex, I'm quite in a long-term contact already, and now I'm very, very happy, Alex, that you took the time and sit here together with me to share some insights on technical analysis, trading, and maybe life as well. So welcome to the podcast. I'm very happy to have you here.
Thank you for the invitation, Wieland. Indeed, we have been we have known of each other for quite some time. Yeah. And I'm very glad with this podcast, our paths to cross, and I'm hoping this turns into a friendship for the years to come.
It definitely will. I'm very, very confident about this. And also that's why I have this podcast, just to get in touch, to talk, to discuss. And honestly speaking, I'm always very curious how people just came to trading, because naturally we're not born as traders. But maybe some people are born as merchants, maybe people are born as being like a metaphysician, like a doctor or something like this. But I never heard of somebody just stepping into the world being a trader. How about you?
That's a very good question, and it brings me back many, many years. The first contact I had with financial markets, well, let me say actually, was through my father. My father was working for Bank of America, and he once took a trip, a training trip to London. So when he went to Bank of America, there he went to the trading floor, the dealing room, and he saw, because he was on the investment banking side of things. So once he saw that, he instilled the idea into me. He said, son, I think you should go into, you should look into trading and go into the dealing room, as he used to call it. Of course, as a child at the age of 15 who wants to impress their dad, I immediately said yes. Although I didn't know at the age of 15 what a dealing room was. But in any case, at the age of 18, I decided to go to, do finance. I went to City University, banking and finance. So that was around the age of 18, 19 was my first idea that I wanted to go into markets. Because although the degree itself was banking, I thought I gravitated more into markets. And I made my decision at the very last year. I took my thesis to be the factors that are affecting the London Stock Exchange. That was with a finance, a macro point of view. And but also something more important to me happened. During my last year, we had an elective course called, at that time, it was called forecasting. The professor that was teaching it was a Dr. Roy Batchelor, who I'm still in contact with. He's a very good friend. Now, Roy was a life trader who then decided to go into academia. But because he was a practitioner, he was using technical analysis. Now, but at that time, when I say at that time, that was like 95, technical analysis wasn't accepted as much in the academic community. So what he did, he decided to teach technical analysis, but not outright. So he put some econometrics at the beginning of the course, some at the end, like sandwich it, and call it forecasting rather than outright technical analysis. So I took that course as an elective, and that was my first contact with technical analysis at the age of 21, 22. I fell in love with it. Dal Jobman's book was the first one I got. So, and I've never looked back since then.
Yeah. So you're by definition a technical analyst by heart as well, right?
Yes, I would say yes, but my style is more what I call MTMF, multiple timeframes, multiple factors. And by that I mean I use different timeframes, and I believe that each timeframe has its own return drivers. And at the timeframes, like for example the monthly and the weekly, I think it's more fundamentally the forces that propel prices. in general, for fundamentals and technicals, I think that technicals answer different questions than fundamentals. So I use both.
They do. Of course. I mean, but by definition, you know, but if you look at fundamentals, you go numbers, products, season, whatever. Fundamentals are this. Technicals, hey, where did the price reverse and why? But why is more technical side, resistance, support, not why, oh, bad product, bad management, bad whatever, bad numbers.
Absolutely. And like you said, I mean, you know, fundamentals answer the question why, and technicals answer the question when. So depending on which question I want to answer, I revert to the different tools. So I use a fair mix of both. But if someone, of course, you know, put a gun to my head and said you will use only one, obviously I would revert to technicals.
Yeah, and it makes sense to combine this. I never understood actually, Alex, why people really are so crazy about distinguishing it. I mean, you have to do a lot of work if you really want to dive deep into fundamentals, you know, like read all the papers and, you know, look across the board and the world, what is going on everywhere, influences and everything. It's easier with technical analysis, so you have an easy screening process. But I assume that if you go a little bit more long-term, you're deemed to be fundamentalist as well. I mean, if you have Apple or Nokia, it's quite a difference, right?
Yep. And to tell you the truth, even in the short term, you can use fundamentals or macro, depending, of course, how you define one macro. For example, you can use intermarket analysis, which on the face of it might look like technicals, but practically it is, you know, fundamental analysis when you're comparing the flows of different asset classes. So you can use macro factors on short-term for short-term trading as well. Seasonals, for example, you can use that. You can use or sentiment on a short-term basis. You can use intermarket on a short-term basis. Now, some data cannot be used. For example, like commitment of traders report or economic statistics we get on a monthly basis. But there are others which they can be used even on a short-term basis.
Right. Yeah. So what do you prefer? You already said you are in some time frames. So you do also intraday or just like, let's say, swing trading from day to day, or what is your style? Or
no, intraday trading is not something I do. I've done it before, but I don't think it's worth for me. And I want to stress the word for me, because whatever I say is my way, not the way. So intraday is not something I do. My two operative time frames, my holding periods, is short term. Short term, I call anything from 1 to 5. And a bit more long term, which goes out anything from 2 weeks and on. Most of my trades are a bit short term, usually around 3 to 5 days, unless I get stopped out. I mean, they can end earlier if I have a very large move or get stopped out. And then sometimes if I feel that there is a big move coming and I've got other stuff on top of it, I might try to hold the position. So that may last probably 2 to 3 weeks. But it also has to do because I'm a futures trader. So I'm not an investor in the sense of stocks. I don't have the luxury of holding positions for, say, months.
Yeah. So why futures? I mean, for myself, I can imagine, because it makes life easier. You don't have all the screening process, you know, like sectors and everything. It's, you know, like a smaller choice. But what other reason is in place for you to be a futures trader, not just going on stocks and, you know, or whatever, stocks mainly?
Well, initially I started as a stock trader, but after a couple of years, I went to leverage investments. And in particular indices. Now, that was a bit of a byproduct of chance initially, because a friend of mine was heading at the firm I was working at that time, was heading the derivatives department, derivatives desk, futures desk, and he left for another company. So they were looking for a replacement. So they thought, okay, is there some way we can cover the position internally? So I was the first one to say, okay, to volunteer. So that was my dive into the deep end. So that's how I kind of like started. But after that, it's always made sense to me because I'm a big picture guy. I like chess, to put it this way. So with futures, dissecting the market into 10 different economic sectors gives me a big picture view. Plus, you have the advantage that indices or FX, or because I actually trade commodities, FX, bonds and equity indices. Individually, for even an equity index has less volatility than the component stocks.
Yeah.
So from that point of view, I kind of preferred it, and I found the portfolio, my screener, if you will, of looking, say, if around 60 to 64 markets, much more manageable. But again, that's just me. It doesn't mean it has to be this way for everyone.
Yeah, I mean, there are several reasons, and especially that's I think the main factor why people trade futures is they go really short term, which means intraday, especially if they're private investors, because if you hold it for a longer time, you have quite another margin going on, so you have to put more money into it. You might have a bigger risk because of moves, right? So it just needs some kind of account to to manage it. But I mean, everybody's talking about futures for the reasons they are the real products, right?
Yep, yeah, of course. They have the advantage of having the leverage.
Yeah.
I've always, and plus, it's akin to many different types of analysis. For example, you can do intermarkets. You can do, from an analytical point of view, I love it. I do also look at shares, but not on an individual basis, probably more like sectors. I was thinking of launching a program for shares as well, but I've never gotten around to it. So for now, it's either through ETFs, that's much of a, if I want to skip the leverage, or futures.
Yeah. Tell us about your style of trading, or what you're especially looking for. As far as I know, you received awards for a very special idea of using the MACD, the MACD. So how is that?
The MACD, right? Well, the MACD started in 2000. The idea started in 2014.
Oh, right.
And it started as following: because I was studying the literature on momentum indicators, and I've basically there were like literally hundreds of them. So I wanted to make a list, of this, try to sort them out, basically take a taxonomy. So I sorted them out in two broad categories. There were like range bound indicators and unbound. So when within each category there were many indicators in each family. So what I found that each family of indicators, irrespective of which one you used, by and large, had the same pros and cons. And in order to alleviate these pros and cons, I wanted to create a hybrid indicator, which would have the advantages of normalized and range-bound indicators, and the advantages of unbound but absolute price indicators, and create a hybrid one. And that was discovered in 2015. And I was using it for up until 2022 on a private basis, never disclosed it to anyone. And then I thought, okay, I might as well write a paper about it. I thought I wanted to share. So what was the best medium for me to share it? So I thought, okay, I'll write a paper about it.
Yeah.
And if it wins, I will, be able to present it to people and, say there is some value, not because I said so, but because two other organizations thought so.
Yeah.
So that's the short story behind the MACD.
Yeah, but what is it about? So, I mean, we cannot share a screen because it's just audio, but maybe you can describe that we have some kind of impression. So usually, regularly, MACD is just, you have like these two averages crossing all over. So coming from the upside to the downside and so on. So how is the MACD?
The MACD, all right. The MACD, what it does, it takes the MACD, first of all, the original by Gerald Appel, is an absolute price indicator. But what do we mean? The actual formula is the 12 moving average minus the 26 moving average. Now, when you take the 12 minus the 26, the result will be measured on whatever the underlying market is. So if it's in pips, ticks, in absolute or points. The problem with that is that depending on what price or the absolute price of the underlying market is, that will also be the value of the MACD. And that means that the MACD for the S&P 500 will be different than the value for the euro, which will be different than the for natural gas. So although I like the properties of the MACD because it's an unbound indicator, and that means that as the market expands, the indicator will follow. It doesn't get pegged at high levels, sort of, for example, the RSI or the stochastic, because you can go from only 0 to 100. And that's the minus that range-bound indicators have. So I wanted basically to normalize an unbound indicator. So I took the MACD, saw its problems. That was the first of the problems. Because it's an absolute price, you cannot compare it across time. Take an example, the S&P 500. It has grown over the past 20 years manifold. And that means that the price of the MACD today is not comparable to the price of the MACD 20 years ago. So, and also it's not comparable across markets. As we mentioned before, it's not, you cannot compare the MACD versus the euro. And because of these two fundamental problems, you cannot create objective overbought and oversold levels. You cannot say the MACD is in this threshold, so the market is overbought. Plus, there were two issues with the signal line that I did not like. The first one is because you cannot feel I found that when using the MACD, the classic MACD, I found that some signals worked really great and some were really bad. The thing is, I could theoretically pinpoint or highlight which signals I wanted, but from a quantitative point of view, I could not do that because I could not say take signals in the MACD when it has a high value or a low value, because there's no such thing as high or low value if it's an absolute price indicator. So I wanted to normalize it. So the first way to normalize it was to divide it by the price of the underlying market. So if the MACD is X value, we take that as a proportion of the market that we are studying. So if the S&P 500 has an X value, the MACD is an Y, so we do Y over X. So we get to put the points in relation with the price of the market. And in theory, if you multiply this number, it will be put to a percentage basis. You can have the MACD percentage, and theoretically it should solve the problem. But practically it does not. Practically it does not, because if you, for example, take overbought and oversold levels for the S&P 500 based on the MACD percentage, and then you try to compare these versus, and these are the markets I compare to in the paper. For example, the bond market, Bund, I had the German Bund, and also natural gas, you will find that they had different overbought and oversold levels. So my question was, why does this happen? Why do they have different? Because we've normalized, which it's everything on a percentage. 5% is a 5%. But 5% actually is not a 5% across all markets, and the reason is volatility. So, for example, natural gas, which is a very, very volatile market, has different volatility structure than a fixed income market, sort of like the bonds. So the idea was how to normalize the MACD, not by price, by volatility. So once I normalized it by volatility, then I found that it had fantastic properties in that it was stable around the mean across all markets. Then I started to examine the local minima and maxima for each market, and I found that they were very, very consistently the same across all asset classes. And even they had different trend structures, even if they had different volatility structures. And for example, when I say different trend structures, as we all know, there is an upward bias for the for equity markets. So for example, if we plot a 200-day moving average on the S&P 500, we'll find that is more than 60 to 70% time above it. But if we take a market, for example, like natural gas, it's 50-50. So it has a different trend structure. I mean, there's an upward bias for the equity markets. But the MACD, despite these different structural differences, for example, on trend or volatility, it had the same properties. And it opened up the door for new pattern recognition opportunities. It was a great way to truly get a momentum readings.
Wow. So you can, of course, you can use it on every market, but it's not on price, it's on volatility.
No, you use it on price, but you normalize by volatility. When I say basically, it's the formula of the MACD, 12 minus 26, divided by the average true range.
Ah, okay.
So you basically you get the level of momentum purified by volatility.
Mm-hmm.
So the residue over volatility is pure momentum. So what you find is that when momentum is 1.5 times its volatility, the market is very overbought. But because the indicator goes between finite levels, it is like normalized indicators. For example, the RSI or the stochastic, where you have the so-called 70 and 30 into 20 levels. Mm-hmm. But you also have the advantage of it being unbound, like the rate of change on the MACD.
Ah, interesting. So I definitely have to check this out. It's already available on some trading softwares, right?
Absolutely, has been very welcome.
About Trading View, but I'm not sure if it's upcoming already in place.
Well, good question. I will be launching it for myself this week, but there have been many other users who have already programmed it, because as you know, trading is an open source product. So a lot of people who like the work already programmed it there. But like I mentioned, I will be doing my own version this week. Plus, it will be available also on MT4. It will be available on AMI Broker. It is available on Stock Charts. It will be very shortly available on Optima and Metastock and other platforms as well.
Wow. So, well, congratulations. You are part of the big indicator oscillator system of the world, built for eternity, right?
Thank you. Well, it was never my intention. I mean, I just basically wanted something for my own use. This didn't start with the intention of writing a paper. Hence the gap between 2014 when I started my journey and 2022 when I decided to publish it. I just wanted something practical. I wanted to solve a real life problem, not just to create something that would have my name on it. I just wanted to get the best of these two types of indicators and create something that works, has both advantages. And that's how it came to be. I had no intention of that. The rest of it just was a follow through from demand.
Yeah, but this is how it's supposed to be. Evolving things, not just having one thing working forever. And that's also because you already said, okay, people just program it by themselves into Trading View. So, okay, no business model here. But it's not necessary, because its contribution to our industry, to the traders of the world, is like, okay, this is what I have in mind. This is my idea. People use it. People work with it. People change things, and then things evolve, they grow, right? So you use the work of Gerald Apple. Absolutely. Now it's another work, but it's based on always, always it gets better.
Absolutely. And the thing is, it's even gotten better than the paper, because I was working it for such a long time, I managed to work out a lot of patterns, which obviously, because of limitations of time, I could not put into the paper. I mean, the paper was already ridiculously long. I mean, it was about around 40 pages, with the average paper size about 15 to 20, if I remember correctly. So obviously put everything. Would be more like a book than a paper. So I'm hoping what I will be doing is I might be trying to commercialize the other stuff which I didn't put in the paper, because a lot of work on improving the signal line. So that gives a lot more accurate readings of trend of change, because the MACD, when someone uses the signal line, there is a lag between the signal line and the MACD indicator. So by using new techniques, I managed to minimize that gap. Not minimize. I mean, there's an improvement of, on average, 1 to 5 bars per side, and that can be huge.
Wow, I definitely have to check this out because you know, MACD is such a classic. Everybody used it, at least, maybe also uses it still, but you know, everybody knows about. And if this really, you know, if this brings things further, makes really a difference, because the basic the idea is amazing, you know. And having it with volatility is very cool.
When I first discovered this, to tell you the truth, I thought it made so much intuitive sense to normalize by volatility that I didn't think anything of it initially. I thought it was, man, it's you know. And then I started looking into the bibliography. If someone else has done it before me, I said, you know, surely must have thought about it. I mean, the MACD indicator has been around for almost half a century. I don't think I'm the only one that noticed it, and there was no one else that noticed it. And I thought, yeah, it made intuitive sense. And I'm happy that I stand as the shoulder of giants like Gerald Appel, because without him, my work wouldn't have been possible to make. Yeah. And I'm hoping that, you know, people will take it forward and improve it themselves.
Exactly. So this is how it works, and this is how, you know, we all get better. And this is how, that's also what I really love on the trading industry, because usually everybody is like happy to share, everybody's happy to discuss, everybody's happy to see how things are going on. And saying this, I mean, we're both on the same, you know, this mailing list from John, where all, you know, everybody's discussing, and I really love this, because you have all these people, all the big names in this mailing list, and they are discussing about things you never thought of they exist. And you know, it's so much to learn over there and to read, and we feel like, wow, these guys, they don't have to discuss about anything anymore for years. But they do it because they love it, you know? That's
absolutely.
really impressive.
Absolutely.
So I really love it. Yeah.
Yeah, I completely agree with you, Wieland. You're quite right. I mean, there is so much knowledge. I mean, and I'm as far as I'm concerned, I'm trying to learn from everyone I meet, no matter how experienced. Because if, for example, you might meet someone who's less experienced, but they might give you a good idea.
Of course.
So it's always, you know, if one keeps an open mind, you can always be learning.
Yeah, you know, people sometimes ask questions where I feel like, I never thought about this.
That's true.
That's true. Like this.
That's
and it's very important. And this is how you learn, how you grow. And I really love this tool. So yeah, that's why also one of the parts and the benefits of making interviews with colleagues, you know, so because you learn so much. Like your company is called Smart, you know, so you have this
Smart Trader Systems. Yep.
Yeah, Smart Trader Systems. So what exactly is this? What do I understand?
Smart Trader Systems. I'm launching the website in a few weeks. At its core, I'll be looking to share my work primarily with institutional investors. It will also have individual investors as well, and looking to take people up the trader development stages, the 5 trader development stages. Hence the name SMART. It's an acronym, basically. I mean, of course, it's a word. It's a play for words, because smart, you know, means smart, but also smart. This is an acronym of the 5 trader development stages. So S is the first stage, and then it goes all up to T. So the company will be looking to share my work, basically, and we'll have 2 primary areas of focus. The first one will be create a learning path. A 15-stage learning path will include technicals and fundamentals. I can show my MTMF method, multiple timeframes, multiple factors. And then also we'll have some support, which will be real-time analysis, signals, basically coaching, community, and commentary for the market.
All right. Yeah. So that's interesting. So what are these stages a trader goes through with, you know, like these 5 stages, the development? Yeah, of course. It's technical, fundamental.
The first stage is what I call the self-awareness stage. Self-awareness stage is the stage when I'm looking from, because the smart system works different for individual than for institutions. Okay, let's start on an individual investor basis. The first thing one has to do is get a bit of self-awareness in the sense of having 3 steps. Sorry, 4 steps. 4 steps. The first one is the goal. The goal is for one to have a very conscious decision on what they want to do. Do they want to be a part-time trader or a full-time one? Do they want to trade for income or for growth? Because you'll have a different path for both these objectives. The second step they have to do for self-awareness are for realities. And realities, I mean, objectively try to look at what is the requirement for the various types of capital they need. They need emotional capital, they need financial capital, they need also an educational capital and also time capital. So 4 types of capital they need. Realistically, how much time they will need, realistically, how much money, because you have to have a certain amount of money in order to, because for example, if you want to be doing it full time, I would say don't even remotely consider it without having at least 50 grand aside, even at the very, very low end of it. And that's, of course, doing leveraged investment, not even talking about stock investments. So you also need to have your time capital, how much time you have per day. You also need to have your emotional capital, check with your family if they're willing to support you along this stage. So you've got these 4 types of capital. So the third step within the self-awareness, the first stage that is look at the obstacles, what's standing between your way. Primarily, I would say in most of the cases, it's mindset. It's a mindset problem, having a DIY mindset for most, at least individual investors. And the last one is your will. And the will is a function of how much do you want this, because you may say, okay, I want this, but there are levels to this. You may be interested or you may be committed. So as part of the self-awareness stage, you have to decide if you are interested or are you committed. So that's the first stage. The second stage of trader development is M for market knowledge. So if you've made the commitment to go from first stage to second, M is for market knowledge. Market knowledge includes both technicals and fundamentals. And for that, I've created a learning path, which goes from monthly, weekly to daily time frame, and it has the various different factors I look at from technicals and macro. Perhaps we can go into this later, but now let's stick to the 5 stages. The third stage is the A for action plan, because at stage 2, which is market knowledge, you learn about the ingredients, the flour, the butter, and the milk. But the third stage, the action plan or the trading plan, as we call it in our, from a trading point of view, that's the equivalent of having a recipe, and knowing about the ingredients is not the same as having a recipe. Now, most people by this time, I mean, as far as private investors is, they quit by this stage. The proverbial 90% of traders lose. I mean, this is probably the last of them have left off, because most of them don't get to learn about the ingredients. The third, and also even if they do, they rarely put it into an action plan, a trading plan. But when I say a trading plan, I mean a rules-based systematic. It doesn't have to be fully automated, but having a rules-based framework. So let me give you an example. If the price is above the 200-day moving average and the MACD is at this threshold level, then I will be buying. Then this is an if-then rules-based trading plan. This is very simple, but it's a characteristic example of how you can have a rules-based framework. So most people quit by this stage and don't get to go the fourth one, which is the R of the SMART model. R means for repeat and review. And this is the difference that makes the difference. I mean, the boys from men, people who are willing to, who are interested and to committed, because having a trading plan and looking at the markets is something that you like, maybe interested, but if you committed, then you will, sorry about this, you will take this to the next level and start working, practicing,
Mhm.
using a demo account, using a mentor, using a trading journal, and so on and so
Yeah.
forth. There's a big process. So that's the R of the SMART. And
Mhm.
the last stage is the T, which stands for trader. Then only then you become a trader after you have gone through the repeat and review stage, which is basically working on a demo.
Mhm.
And because there is a process to go from demo to live, and once you go live, how you actually scale up your size. Again, there is a process for that as well.
Yeah. Yeah.
So that's the short version of the SMART trader
Nice.
development
Nice.
stages.
I really like this idea. I mean, this is really just a journey to become a professional trader. And I also really like the idea because you already include like everything about mindset, uh, you know, financial behavior, so whatever people like to call it, but it's already inside of self-awareness, market knowledge. Of course, I mean that's what we stand for, right? Like technical analysis, like fundamental analysis. This is amazing. I really love the idea of having an action plan and call it like this, so like, okay, this is strategy, it's an action plan. I like it really. So it's amazing. And also repeat and review. And this brings me back also to, to the big names, the giants in our industry. They never stop repeating, reviewing. So I can just recall recent IFTA conference where we had some over there, like Darryl Guppy, John Bollinger, and they were really committed. They were more committed than most of the visitors. Why? Because they were there watching every single presentation from beginning to end.
Yes, that is
That's commitment, right?
and it's
These are traders.
it's really special. And of course, congratulations to IFTA for putting together such an event. And it's a service to the community at large,
Yeah.
because by going there you can watch all, like you mentioned, all these presentations, and one can learn so much. I mean, literally you can learn so much.
Yeah, definitely. So, I mean, this is also something a lot of people feel like there's just a short way, a shortcut. You can just be a trader, have just a very short course, watch some YouTube videos, read half a book, done. No, it's not that easy. If it would be that easy, first of all, everyone would be a very successful trader. Obviously, the opposite is the case. Second, if it would be that easy, everybody would go into it. But it's a fight sometimes. Sometimes it feels like you're really working against yourself as a trader. And this is where really, which separates boys from men, what he already said, like review and repeat and review, which separates like the kid from the grown up. Let's take it neutral. So this is really, really important also to follow as a trader. It's some kind of evolution, isn't it?
Yes, absolutely. Well said, Wieland. It's just a matter of of will, putting the hours. And it's not different than, in some respects it's different than other industries, but in some respects it is not. For example, I think that the trading, learning to trade is pretty much has the same common characteristics as the weight loss industry. You get a lot of people who are trying to promote the new idea of how you can eat burgers and pizza, but
Yeah,
at the end of it, and lose weight, and you don't have to go to the gym. But at the end of it, we all know that losing weight is a simple formula. You have to eat less than you consume, less than you actually spend, go
yeah,
to the gym, deprive yourself of things. But
yeah,
in trading, you have to do things, learn the fundamentals, which is basically work, learn the basics of, but we'll know the new shiny indicator or the new shining technique and go to YouTube. Because basically someone will tell you what you want to hear,
right,
that this
exactly.
is easy, this is fast, and you can do it without any effort. But nothing worthwhile comes in life without effort.
It's funny that you mentioned exactly this because exactly today I was just browsing some headlines, while waiting for something, and I came across this headline was like there's a diet injection which helps, which really helps, but if you don't use it anymore, people complain that they're gaining weight again. Well, of course. I mean, what do you expect? You know, like, okay, if you don't use it, if you don't change anything in your behavior, I
Yep,
mean,
yep.
of course, you will gain more weight. I mean,
Absolutely. And that's
you know,
one of the reasons, just give me a second. That's one of the reasons why when I talked about in the self-awareness state,
yeah.
the self-awareness stage, it was always about checking out your will, seeing how
Mhm.
committed you are, because there are levels to this. Being interested is not the same as being committed. Being
Yeah,
entertained is not the same as being educated. Watching a video on YouTube, you're not getting, I mean, you're actually getting entertained. You're watching a show, someone else talking about market, but opening
sure.
up a chart and trying to do it yourself, following a framework, a step-by-step framework, and then seeing what you're doing wrong, having someone help you with it. And that really, really takes effort and time.
Yeah, exactly. So yeah, a lot of things to learn for a beginning trader and also for a mature trader. And I can just recall it. I just can say it again and again and again. These guys, the big names we're talking about always, they don't have to do anything anymore for ages. They're done already. But still, and this is real commitment, they're so much into it that they don't want to miss a single word and just go to toilet in a break. Done. Right? So that's really role model, not just trading or indicator. No,
Yeah.
it's exactly
Will,
this behavior.
absolutely, absolutely agree with you. That's why I've always said that do whatever you really love, because
Yeah.
that's that way. Work. I think Confucius mentioned this, but I'm just paraphrasing him. That in that way, work will not seem like work. I'm not saying that it won't be hard, but you won't be doing it, exercising too much motivation or say, okay, let's try to get this done. No, because you actually love it.
Exactly. From your point of view, how long or how much time do I need to become really a successful trader? So when I start from
So yeah, good.
scratch.
That's a good question. Well, it depends on many factors. What I can give is the absolute minimums, and based on my experience, what I have seen. So in general, I
Yeah.
would say the answer differs from person to person. The simple
Mhm.
reason is, okay, someone is, for example, let's say someone is maybe a retired banker
Yeah.
or who has been laid off work, and for the next, say, 3 to 4 months, decides to give a try to learning how to trade and say, okay, I'll try to do it. If it doesn't work, fine, but I'll have 3 to 4 months dedicated. But he's doing it full time.
Mhm.
Obviously, he will have more time rather than someone who's doing it at the evenings.
Yeah.
So that's an important factor that will
Sure.
also make the question relevant to the person. Another thing is prior knowledge. Prior knowledge may also sometimes may be a hindrance, sometimes it may benefit depending on the person. So if someone has come with prior knowledge, but he's picked up a lot of bad habits along the way, and he's not willing to unlearn before learning, that will also add time because it will be more difficult for him to accept a new reality other than the one that he had created in his mind, in his head. So,
Yeah.
but for someone that comes with prior knowledge but is willing to let go of bad habits, has less ego, to put it this way, that will make the trip shorter. But to give an estimate, I mean, if someone really wants to do it, I think it's safe to say, and in general as a principle, that people overestimate what they can do over a weekend, but underestimate how much they can do in the course of, say, 6 months.
Yeah.
So I would
True.
break down the process in two parts. The first one is the theoretical, which
Mhm.
I would give it back to Pareto's principles 80-20. I mean, I could give you notes, I could give you material that would take about, say, maximum 3 months, a maximum of it, really
Mhm.
maximum. But then focus on the practical side. So for that, I would say probably say another 4 months, 6, depending on the person, how much willing
Yeah.
they're to spend time practicing, because I think that's the most important bit. But it's doable within, say, 9 to 12 months. Definitely, it's definitely doable.
Yeah. All right. So let's say maximum for most people, if you're really committed, put time and effort into it, like 12 months as a rule
Yeah, I
of thumb.
think that. Yeah, I think that's a fair amount. Yeah, I think that's yeah, that's a fair amount of time.
Yeah. And of course, not to forget that you never stop learning. I mean, honestly, right? But yeah, just where you feel like, okay, now I'm good to go. I can start and make more experiences and maybe get also some money out of it and not just put something into it. So
Yeah,
this
yeah, yeah.
is as well.
And yeah, of course, it's not also it's also the process that one has to do. For example, how do you launch a strategy? How do you go from theory to practice? That's also very important, because it has it bears consequences both from a financial point of view and also from an emotional point of view. And I think that the emotional capital is more valuable than the financial capital, because the financial capital can somehow, unless you mean like really go bankrupt, can always be replenished. But the
Yeah.
emotional capital, once it's damaged, it's more difficult to get back. So that's why
Yeah.
I think that, preserving your emotional capital is a very important. A way to do that is through, I'll use a dirty word, something that's a bit more unpopular, demo trading.
It's not dirty at all because, yeah, it's unsexy, of course,
Exactly.
and it feels boring, but it's not. Demo trading is that you gain confidence in following your own rules, is confidence in, let's say, spotting the right situation and
Absolutely.
then just jumping into the market, just following also the strategy. And if
Absolutely.
you go with this, okay, you can go live, of course.
Absolutely. And with, some people, I'm saying this because some people criticize that demo trading is not the real thing. But my reply to this, it's 80% of the experience with 0% of the risk. And you've got the exact same thing in other industries as well. For example, airline pilots, they do demo flying. They seem like in flight sims, or medical students, they operate on cadavers before operating on a live person, or lawyers, they have mock trials. So, everyone, a lot of industries use that.
Yeah, they're better off doing so because they can develop some habits, like, okay, is it a routine to follow, how things go. So they don't have to rethink what they're doing in the battlefield, to call like this. I mean, it's a little bit martial, but anyway, if you're into trading, if you're in a market, you have to focus on yourself, not on the market. And if you know how to do things, because it works on an automatic routine, you're better off, I think, So that's what a lot of people forget. That's why they feel like it's not sexy, but it is.
Yep.
Because it's, it protects your assets as well and your mind. You're totally right. Speaking of, I mean, risk and mind is also very connected. So how do you manage risk?
Good question. Risk can be managed on many levels. First of all, in order to manage something, you first of all have to define it.
Yeah.
And there are different types of risk. At its core, the two most basic and important ways to manage risk is through position sizing and also having a stop loss.
Yeah.
And with these two, it's one of the few things in trading that I'm absolute about, is using stop losses and having a small position sizing. I mean, with other stuff, I might be watered down my opinions and say, okay, you might see differently than I do. I have no problem. But these are the two things that I'm really, I have strong opinions on, having small position size and a stop. These are the two cores, but there are some other types of risks. For example, you might have strategy risk. And for example, if you're using pullbacks, I'm just mean reversion, and you're using 3 different mean reversion strategies on the same product. Now you have strategy risk. So because you're trading the same idea off of the same products, it doesn't really much sense. So you have to diversify across strategies. Now, another type of strategy, another risk you may have may be correlation risk.
Yeah.
Trading the DAX, the S&P 500, the FTSE doesn't make much sense because you've got equity exposure. I mean, theoretically you can do it, but you have to adjust your exposure to that. So that's one thing you have to do. Now, you also might have time frame risk. You can also have liquidity risks. There are different type of risks that you may have and encounter. So again, risk management is a very, very broad subject. I'm just trying to keep it simple because from an individual investor point of view, the balls they have to juggle are less than from an institutional point of view, because their portfolio is more agile and smaller.
Yeah, and basically, I mean, they're just trading one product, or if they go levered, they go with, I mean, most of them is Forex, CFDs, not so much futures, but it's growing. But yeah, it's not so much to look for. And basically, most of it is stop loss, totally agree. Position sizing, totally agree as well. The higher the lever, the smaller the position size.
Yeah, absolutely. And I tell you, even if we bring it to, for example, we talk about Forex or CFDs, I mean, the same principles apply there. For example, you might say, okay, I want to be long the euro versus the dollar. Then I want to be pound, the cable, but the pound versus the dollar. Then I want to be, I mean, you can pick a number of currencies versus the dollar, but you have one short dollar exposure in total. So that's definitely a thing to be wary about.
Yeah, it's true. It's true. Yeah, so with the risk thing solved, now let's say I'm starting as a trader. I have some ideas of how to manage my risk. I have my strategy, and I also think about a bit how to adjust my mindset. Being a trader, I have my demo trading. Do you think I'm good to go, or did I miss something?
Well, in the beginning steps, I would say you're probably missing the human factor, the mentor.
All right.
Because you can have a book, but page 56 will not tell you what you're doing wrong.
It's true.
So,
it's so true.
and theory from theory to application, let me put it another way, information and implementation are two completely different things.
Right. True.
And unfortunately, as far as education is concerned, a lot of people have misplaced the importance of implementation at the expense of information. So because it gives them the idea of a magic pill. I can show someone the information, but the implementation I think is much more important. So coming back to your question, they're missing the implementation aspect of it and someone to guide them along the way. Someone to, for example, like a mentor or a coach who can help them and provide critical feedback. Also motivation when they're down. Also try to put them back on the ground when they have a winning streak, but someone to do hand holding, and a mentor is part of the implementation process.
Yeah. It's so true. I mean, I always have a conversation like this with with the colleagues, and we all agree on this. You can read books, you can have the YouTube, you can watch video courses. We all have video courses.
Absolutely.
I offer you maybe, but what is it good if you don't have someone just to show you the way, to guide you, to be on your side as a mentor? Totally true. You totally got it. And that's the main point. And of course, you need to have a proper strategy, right?
Yeah. Basically, a mentor will help you to, first of all, to teach by example, to show you what they're doing. And the second thing is also review what you are doing wrong. So, for example, if someone wants to, makes a wrong entry or a wrong exit, you need critical feedback because you can't be both the doctor and the patient as well. And it's of course also useful to have a community around that, but have other like-minded people who are in the same learning path, either at an earlier level or at a later stage, so you can share experiences.
Yeah, true. As a last question, because I'm just looking at the watch and we're almost like 1 hour, which is a good time.
Time flies when you're having fun, as they say.
Time is running, it's crazy, right? So basically what I really also like to ask you is, because a lot of people thinking about this as well, like, okay, so how rich can I be within a year or something like this? So what is really realistic when it comes to profit targets? Like, is it like a 1 to 5, or is it a risk reward ratio, or is it something like you're making 120% a year? What is your idea about this?
Well, first of all, in order to speak about returns, we have to talk about risk.
Yeah.
Because someone who's willing to risk 10% of the portfolio will have a much different theoretical upside potential rather than someone who's willing to risk 20%.
Yeah.
So if we put it in R multiples, like Van Tharp said, so if someone goes around, again, I'm trying to think from a private point of view, not from an institutional. From an institutional point of view, if you get 1.5 times what you risk, then you're pretty good, you're pretty solid. Right. But obviously, private investors want a bit more than that. But I would say, okay, probably 2 or 3 times maximum of what you're willing to risk. So if you're willing to risk 10% of your portfolio, you shouldn't be expected, to realistically to make more than 20% or 30% at the best. Of course, you theoretically you can do, but it's not what is possible, but it's also what likely.
Yeah, true.
So this is what I would do. I know most people want to be achieving higher returns than that. It is achievable, but what I'm saying is it will come at a cost. And these are discussions that one has. If we go back to the smart trader development stages, back at the S, the first stage, the self-awareness, because these questions come up at then. Okay, how much can I expect?
Of course.
How much are you willing to risk? Once you've got that into place, how much I'm willing to risk, then you can set them out in a monetary figure.
Right. I mean, yeah, it's very easy to say, yeah, well, just make 10% of my account. Because why people say like this, they always feel like the next trade will be a winner anyway. So I can risk more, which is a bad decision, of course. But, people are always very confident because everybody tells them, you're a trader, you're going to buy Lambo. I'm over-exaggerating a bit, but this is what people feel about. I'm getting rich. Oh, you're a trader, you're rich. No, I make a living. What? You just make a living, you're not rich. So, so this is
it's the hardest job to make an easy living.
Yeah, it is. And but also it's one of the most interesting jobs as well. You meet a lot of great guys all over the world. I know myself because I'm traveling the world, meeting all the great guys. So yeah, it's hard, but no, it's great.
Absolutely. I completely agree. I think we're on the same page.
Exactly. And I would like to have this as an ending statement, right? So being a trader is a great job, great decision, but it comes with a price, right?
Yes, I like most things. But I would like to I like to focus on the positives, which is that it is achievable. It's definitely more, it should be more than 90, they say 90% of traders lose. You should have probably more than 10% of success. And it's individual. If someone's willing to put more than the average, they can definitely do it. There's nothing, and speaking from experience, there's nothing special about me. I'm your average guy that you will meet in a pub. It's just the difference, at least in my case, that made the difference is that I love what I do. That's it. It's not about intelligence. It's not about having a finance degree. It's not about having connections. It's just about loving what you do and willing to put the hours. Other than that, we live in an era where there is abundant information. And if you're willing to put the work into the implementation, it's definitely doable.
Period.
Amen.
Amen. That's totally it. Alex, thank you so much for all your insights and well, also some great explanations. And yeah, I couldn't agree more to what you said. So once again, thanks for sharing. Hope to see you next time live and in person somewhere at a
I
conference.
hope so. I
World.
hope so.
So,
Perhaps at an IFTA conference.
yeah, it will be. I cannot disclose it right now, but
Of
it will
course.
be around the area I'm right now, and I'm in Asia.
There's a hint for you.
Yeah. All right. Okay, Alex. Thanks, and
Take-
see you next time. Bye-bye.
Absolutely. Take care. Thank you, Wieland.
That's already it, and I really hope that you enjoyed this episode and you took away some learnings for your personal trading. If you want to learn more about me, about my interview partners, if you want to have a one-on-one coaching or even get into a training course with me or my interview partners, just get into the show notes and follow one of all these links you find there, and then I will be happy to hear and see you again. Your Wieland Arlt.